Good morning, good afternoon, and good evening, everyone. Today we'll be covering XPO Logistics, which is a short idea with the ticker symbol XPO listed on the New York Stock Exchange. I began coverage November 30th, 2023, revised and coverage updated since May 6, 2024, and have been following ever since. Okay, so a bit about myself before we get stuck in. I'm a CFA Level 1 candidate, currently awaiting test result in early October 2024. I've graduated from university with a Bachelor of Commerce in 2020 with a major in finance, in 2022. Passionate about investment analysis, trading and investing, and all things finance. Draw a lot of inspiration from Bill Ackman, Warren Buffett, and Celeste Carmen, etc. What outcomes I hope to achieve from these videos? Exposure and networking purposes. While it's one thing to build a financial model, research deeply into a company and its industry, it is another to effectively communicate to clients and potential clients. Potential recognition from employers or recruiters, help build a reputation among hiring networks, have my research receive constructive feedback. What can I improve upon? Makes me a better analyst in terms of alpha generation and risk reduction, and potential to meet like-minded individuals and form a partnership. Two sets of eyes are always better than one. Okay, so on the agenda today, we have a disclaimer, cheap Sigma investment criterion, the investment process for such, investment processes, risk and limitations, business overview, comparables analysis, identification of bimodal outcome, and the mispricing and valuation. So please pause the video. Feel free to read. The basic premise of this disclaimer is the presentation does not constitute a personal recommendation or solicitation to buy, sell, or short any securities. The information herein is not a recommendation to short XPO, but simply our own analysis and opinion. Okay, so cheap Sigma and short investment criterion. Cheap Sigma or undervalued standard deviation is predicated on the idea that markets sometimes trend and that volatility will dramatically understate the potential price move of markets that trend. Jamie Mai or Cornwall Capital, as featured in The Big Short book in 2010 and the movie in 2015, which I assume a lot of you have seen. So I kind of put these two strategies together. One's more of a trading strategy, which is cheap Sigma, and short investment criteria is more of a long term. And I've kind of compared them in a tabulated form. So we'll go through cheap Sigma, which looks at implied volatility of option prices. We look at a price move that has occurred. This could be any time frame, and to see if it's over 3.5 standard deviations. So highly improbable mathematical event. We also look at low implied volatility and historical volatility, meaning lower option premiums. The market complacency has reflected as such, meaning they haven't priced in already the potential move. Stock is trading at 52-week highs. Normality test indicating prices are assuming normal distribution despite presence of bimodal outcome. Technical analysis indicates the asset is oversold or overbought due for a correction, whether fundamental, technical, and or mathematical factors pointing to a major correction or mean reversion. Then we look at short investment criteria. We look at if a business has sophisticated, unpredictable, and poor free cash flow generative business. Insignificant barriers to entry, high exposure to extrinsic risk that we cannot control, weak balance sheet, large capital markets dependency, poor or ceiling on valuation, and poor management and or governance. So with the investment process, we look at identification of a bimodal event, normality testing, and then the implied historical volatility calculations, and then the Black-Scholes calculation to infer what assumption the market is pricing into option prices, and then we look at our own. So investment processes, limitations, and risk. Under CFA Standard 5B, investment analysis, recommendations, and actions, communication with clients and prospective clients. The basis of this is, as stated in the disclaimer above, there is a chance that the actual results may materially depart from estimations and the projected results herein. Please pause, please read this. It's more just covering what I was talking about earlier in the disclaimer, and it's required under CFA standards. XPO Inc. Business Overview. XPO Inc. XPO Logistics is an American transportation company that conducts less than truckload shipping in North America and transportation services throughout Europe. The company has headquarters in Greenwich, Connecticut, US, and has 564 locations globally. Its market cap with an equity market value of 10.05 billion, a div yield of 0%, and a price to earnings of 101x. The stock price as of 14th of March was trading around $122.66. It's currently trading a bit lower than that at the moment, but has been in that range for quite a while. A daily volume of around 1.8 million shares is traded. XPO Business Review. What does XPO do? XPO is a provider of these freight transportation services using proprietary technology to transport customer goods across US and Europe. The two reportable segments are the US LTL segment and the European segment. LTL shipping is a transport of goods that do not take up the full load of a truck, sorry. LTL helps combine shipments from multiple customers, sometimes slower delivery times, however, inexpensive way of goods transporting. How does XPO make money? As the basic formula states, price times volume equals revenue. For XPO, revenue is derived from customer volume to prices set by XPO for the delivery of goods. Prices are largely variable from business to business. A lot depends upon weight, size, and other applicable dimensions set by the customer. A large portion of revenue derived from LTL sales and service to 27,000 customers in the US to a total of 48,000, including EU segments. The services range from many different companies, small to large, such as industrials, retail, and e-commerce, food and beverage, and etc. So how does LTL actually work? As we see in this diagram, we have more than one shipper in the same truckload versus just one shipper using a truckload shipment. And we can see with pallets filled up with different dimensions depending on what the customer is actually transporting. So financials breakdown. Here we've got a handy chart from Guru Focus. This was as of the end of 2022. We've got the North American section and the European transportation section. A combined revenue of 7.7 billion, gross profit of 1.2 billion, a 16% margin, operating income of 549 million, taken off your deductions, pre-tax of 258 million, and a net income of 668.0 million. XPO is a classic short investment. XPO is a logistic company with unfavorable attributes. It is a large and competitive company, however, is losing market share in the US LTL industry, equivalent to 14.83% year-on-year compounded annual growth rate over the past 5 years. While the US LTL industry has grown 4.2% CAGR in that same period. Large exposure to extrinsic risk factors that are out of our control, with a high beta of greater than 1.35 versus the S&P 500, significantly high cost of capital versus very low return on invested capital over 5 years, great variability in operating cash flows, unpredictable and seasonality affected revenue streams, and asset sale dependency, substantial variable cost expense base, limiting operating leverage, and transitioning over a 5-year period to a more capital intensive business or business line warehousing. Accounting issues, poor and variable earnings quality, and business require extensive access to capital markets to survive, having high liquidity and bankruptcy risk, with debt to equity ratios of around 2.69 a 6-year average, and equity multiple at 5.10 at a 5-year average, and a lowest interest coverage ratio of 2.61 as compared to applicable comps. So here's the stock price over the last 5 years. While it does look really well for shareholders, and shares have appreciated 400% greater than within the last 5 years, shareholders have earned quite a good capital return, despite earnings per share and free cash flow per share not improving over the same period. Management words don't match their actions. As I see quoted, importantly, our LTL business historically has generated a high return on invested capital and robust free cash flow, as they listed in their 10K report in 2023. We break this down through our calculators, SEC filings, and as we see here, we see a negative free cash flow per share year on year, and dropping to a 5-year low at negative 23.03. Then we look at, despite scale and age, XPO's return on invested capital is less than its weighted average cost of capital in its US and EU regions. They saw a large decline from COVID. Return on invested capital and recovery is meaningfully lower and impacted throughout decline of capital efficiencies and XPO's balance sheet management. And we could see large dead ends for return on investment capital growth, with a current spread of 373 basis points. How about versus comps? XPO's return on invested capital is less than Old Dominion Freight Line in its US and EU regions. Old Dominion Freight Line's ROIC is significantly higher than XPO's ROIC. Old Dominion Freight Line also maintains a return on invested capital greater than its weighted average cost of capital, while XPO struggles to grow its return on invested capital greater than its WACC. A value destroying business model. A previous short seller report from 2018 about XPO acquisition failing to produce tangible value. So this is from Spruce Point Capital Management and their research report, and I did actually learn quite a bit from the report itself. Obviously, a lot has changed and they have done to improve. However, I still see some red flags. Timeline of acquisitions and disposures, signs of a non-economical model. Despite with all the cash gained from disposures of key business operations, the XPO still fails to provide positively growing free cash flow. After they acquired Conway, a transportation and logistics in 2015, they no later than a year sold the truckload division to Transforce for $558 million in cash in 2016. In 2021 August, they spun off their logistics business, contract logistics, and its managed transportation and last mile logistic businesses as well. So GXO and RXO, which are also trading. March 2022, XPO sells its intermodal business to STG Logistics for $430 million pre-tax gain net of working capital and transactions cost. In 2022, Brad Jacobs, founder and CEO, steps down. Mario Hurrick steps in as the new CEO. And December 23, XPO receives approval from Delaware Bankruptcy Court to acquire 28 service centers from Yellow Corporation for $870 million as part of a Chapter 11 bankruptcy plan. And that leaves us here. What part of XPO's business may be sold off to bolster financial results? So we've got a little snippets from a Morgan Stanley analyst cutting their stock rating to underweight. I think they have since updated this. It's very whipsaw, and it can be misguided when looking at institutional ratings and upgrades because quarter on quarter they significantly adjust where they might look based on very short term and little numbers rather than the long term and larger picture. But as we see here, highlighted, nevertheless, the analysts expressed concern that not all aspects of the company's potential earnings growth are unique to its operations. And then we talk about the Yellow Corporation, when they bought them off from the market, may be overestimated. According to analysts, the anticipated industry-wide benefits, such as increased volumes, pricing, and margins, have shown to be less pronounced than expected. And they highlight the accelerated capex and an increase in organic capacity. While most companies operating with substantial excess capacity and convergence in service quality among major providers, differentiation is becoming more challenging, and with XPO's current stock price, according to Morgan Stanley, reflects expectations of near record revenue and margin growth, which is nearly twice the valuation benchmark of its peers. XPO acquisition of Yellow Corporation and capex is overrated. In conclusion, the analyst highlighted the LTL's industry's accelerated capex increase in organic growth capacities. As we said before, it's largely already saturated by a wide range of competitors such as FedEx or UPS. And this comes with substantial excess within the LTL offerings to customers. And then we see the convergences in service quality among major providers, differentiation becoming more challenging, which leads to a decrease in pricing power, squeezing operating margins for XPO, which are already less than double digits compared to comps. So a value destroying business model. Of the projected $1.066 billion of capital deployed, it has the potential to lose an estimated $2,328 million adjusted free cash flow to firm, pointing to signs of a non-economical business model. So we break it down for the last 3 years. We look at EBIT, we add back, we calculate free cash flow to firm. We look at any asset sales or business segment sales, any non-controlling interests. Then we adjust the free cash flow. And then I look in 2023 here, we see the $810 million, which was the Yellow Service Center acquisition cost, any rebranding, integration, and deal cost. And then we look at total acquisition cost and then cumulative. And we have cumulative of $1.066 billion. Incentives count. What is it to XPO management with minimal vested interest? As Bill Ackman quoted, incentives drive all human behavior. Institutions have a majority lion's share 88.5%, with hedge funds trailing close at 10.6%. Insiders holding less than 1% at 0.8%. Why would the CEO's comp increase while overall company performance declines? Mario, the current CEO's compensation has increased more than 20%, while company earnings have fallen more than 20% in the past year. Then we look at long-term financial ratio analysis over 6 years, year-on-year CAGRs. Please pause to have a look. All ratios have had negative increases and or decreases over the 5 to 6 year period, i.e. increases in debt to equity and equity multiplier over time indicates more leverage being taken. Asset sales are used to enhance operating leverage. XPO does not explicitly break out these gains or losses except in cash flow statements, but in the worst case, it is temporarily inflating EBITDA by running gains as a reduction to direct OPEX. As we see here, direct OPEX consists mainly of personnel, facility expense, and gains and losses on the sales of property and equipment. As a percentage of revenue, direct OPEX in 2022 reflected the leveraging of compensation costs across the large revenue base, almost entirely offset by the lower gains on sales of property and equipment. Gains from sale of property and equipment account for greater than 8% of total OPEX year on year. And they are used to bolster cash flow and leverage. As we see here, the average growth rate from the gains from the sale of property and equipment has grown to 36.34%. Why would a business with robust free cash flow need to bolster results? Then we look at and break out the shareholder equity reduction analysis. We see no share repurchases in the last 3 years, and they have drastically decreased equity over a 6-year period. We break down the respective line items that have contributed as much. The most worrisome include our recent trend in the decline of net income, the increase in accumulated deficit, and drop in additional paid-in capital. As we see here, when they spun off the GXO, the contract logistics segment, for $1,199 million, contributing to the decline in additional paid-in capital and equity. Such changes cause our return on equity calculations to be high in the double-digit ranges as total equity decreased to the denominator. However, net income declined over a 6-year period. With a sudden decline in 2023, even with net income increases in 2022 and 2023 after spin-off, return on equity returns to low double digits, while net income also returns to 6-year lows with only $79 million difference to 2020 net income. Comparables analysis. Valuation of public comps with sales, EPS, PE, and operating margin figures. So please feel free to pause the video. I don't expect you to read all the numbers and follow along at the same time, but we kind of break down the comps by 3 categories. So we've got logistics, integrated, and then the actual truckers. So obviously some big names a lot of you might recognize like FedEx, UPS, and some other ones like Forward Air and CHR or CH Robinson, I should say, sorry. And then at the bottom in gray, we have XPO Street figures and then ADC adjusted figures. Okay, so what we look at the bottom here highlighted, XPO is among the bottom percentile of EPS of its peers. When adjusted, it is dramatically lower than all of the above peers. Lowest average projected sale growth among comps at 4.99%, just as a street number, and when adjusted, even lower. XPO has the highest price to earnings ratio among peers, with worsening EPS growth CAGR negatively affecting its PE ratio. As we can see, even with the street numbers about 70, we readjusted from our original 101x, but with its worsening EPS, that goes up again to 83.48. That's the street figure. And then our adjusted figures is 107.49 versus 236.84. Valuation of public comps using estimated sales, EBIT, price to book, net debt to EBIT. As we see, it has one of the highest price to book ratios among all comps, just behind Old Dominion Freight Line at 15.03. Its highest net debt to EBIT versus all comps at 24.75 for 2023 estimated. Its credit ratings of comps. So we also look at the same three categories, I should say, sorry. We have the truckers, logistics, and integrated again, and then XPO on the bottom. As highlighted again, feel free to pause and read. But as we see, the highest debt to equity ratio in 2023 with the highest, sorry, I should say the lowest interest coverage ratio among all comps. Look at its comp stock price movement in the logistics segment, its integrated price movement over 1 year, and its truckers. XPO market share decline versus comps. US LTL market share of comps in 2023. We did this by retrieving IBIS, world data with the industry total revenue of 224.8 billion. And we calculated what the three largest truckers, so we've got Old Dominion Freight Line, Saia, and XPO. While XPO has the greater market share than its stated competitive peers, over the last 5 year revenues have decreased 14.83% and lost 11% CAGR market share over the same period, where Saia and Old Dominion Freight Line have increased market share in positive double-digit range. As we see here in tabulated form, XPO has lost 11%, Old Dominion Freight Line greater than 12, and Saia 16%. And we look at the industry revenue over time, over 5 years, it's grown nearly 4.2%. We conclude among XPO's competitive peers, XPO is potentially losing market share to Saia and Old Dominion Freight Line, which have both increased market share CAGR greater than 12% over the same period, while also increasing revenue CAGR by greater than 7.5%, respectively. Cash conversion out of cycle. As the nature of LTL business, XPO, Old Dominion Freight Line, and Saia do not report inventory, as US GAAP refers inventory to assets held for sale during the ordinary course of business. LTL companies obviously don't own the goods they transport, not requiring reporting. Other reasoning includes inventory is materially insignificant regarding overall financial position. So we had to break it down and look at days sales minus DPO, or days payable outstanding, and operational cash cycle days, which is day sales plus DPO. So we just minus them and subtract them to get cash flow efficiency and operational cash cycle days. Versus its comps, XPO has the least efficient cash flow efficiency and the highest operational cash cycle day among comps. As we see here, 33.91 negative, which is good, really good number actually. And then we see here an average of 21.36. Identification of bimodal event. So first step, identification. Does a bimodal outcome exist? Either the stock has overextended or overreacted to such news and or event, and if so, the price of an asset must go up or down significantly from its strained current price. When volatility is low, it is very cheap in an absolute sense, and because the market certainty and complacency reflected by low volatility often implies an above average probability of increased future volatility. Once identified is in the presence of a bimodal outcome, begin review on underlying asset prices, option prices, and normality tests. So, does XPO meet factors that could positively influence its credit rating? We get this from Fitch's ratings for XPO's credit rating, factors that could individually or collectively lead to a positive rating, action, or upgrade. So, as I stated, solid execution on XPO's LTL 2.0 growth and margin expansion targets supporting stronger CFO and CapEx to debt ratio numbers above mid-single digits. We expand upon the next slide how growth and margin expansion targets will fail to support stronger CFO CapEx debt ratios. And they say here, adherence to a capital allocation plan that reduces gross debt and retains financial flexibility. Reduction in leverage to 2.0x or below on a sustained basis. XPO has meaningfully failed to reduce leverage on a sustained basis, as alluded to earlier. Debt to equity ratios over a 6-year timeframe have averaged around greater than 2.2 times debt to equity. CapEx for XPO is subprime. As they say here, solid execution on their growth and margin expansion targets. Above mid-single digits, this is incorrect. As we see CFO to CapEx, we break down each one. The CAGR decline of negative 23.42%. As XPO ramps up CapEx, cash flow isn't rising proportionally. We attribute this to market saturation and increased competition. As alluded to earlier, market share declines for XPO. Then we look at cash flow from operations to debt. We also see this actually increasing over time and then dramatically, or sorry, I should say a massive decrease and then increasing over time marginally. CFO to capex to debt. We see the gradual then sudden decline in CFO to capex to debt ratio in 2022 and 2023, respectively. We use this measure to see if XPO can generate enough cash flow to cover its capex debt obligations. As the values are subjective and open to misinterpretation compared to other various securities, any sudden decline in this ratio can be universally accepted as a bad sign. XPO acknowledges indebtedness and credit rating risk. As I stated, execution of our strategy could depend on the ability to raise capital in the future, and the inability to do so could prevent us from achieving growth objectives, as they quoted in their 10K report in 2023. And then another, without investment grade credit ratings, we incur increased interest expense and borrowing costs and may have reduced access to financial markets to obtain additional debt financing or refinancing our existing debt, potentially adversely affecting our financial condition and results of operations. These increasing interest expense and borrowing costs will require XPO to dip largely into the cash flow to fund indebtedness. We estimate an actual or perceived downgrade of XPO would have negative consequences to the company and create drains on the company's liquidity, thus creating liquidity risk and affecting operating cash flows negatively for interest payments, which ripples into the DCF valuation. We look at the XPO synthetic credit rating. We estimate by calculating a synthetic credit rating, the XPO should see perceived actual downgrade from current ratings due to sustained over-leveraging, inadequate interest coverage, and poor balance sheet management. So based on a 6-year interest cover ratio of 1.73, we estimate a credit rating of about B- versus its current double B+. We also see large reliance and over-leveraging on equity and debt financing, as alluded to earlier, debt to equity ratio and equity multiplier ratios. Mispricing and valuation. Multiples of valuation assumptions. So we break down each line item, we look at a consensus, then we look at the normalized figures that I've calculated, and then we have comments as why we added these. So we break down a first EBIT, we use the consensus, then we less pension income, incremental accrued wages and salaries pressure, and bad debt expenses. So pension income. Pension item lines are reported are non-operational and can be used to mask underlying weaknesses in XPO's model. As they quoted, we have historically realized income rather than expense from these plans. And then we look at the next line as incremental accrued wage and salaries pressure. History tends to imitate itself. Union and Senate inquiries dating from 2018 investigative details provided by XPO short report by Spruce Point, including not limited to October 2021, XPO underpaid workers and agreed to pay $30 million to 784 drivers, claiming the company paid them less than minimum wage. Then we look at bad debt expense. XPO does not provide any disclosure on the exact bad debt expense amount, rather aggregates it in the sales and general administrative expenses. The amount retrieved from Spruce's report, where XPO was charged $24 million to expense, the real number could be larger due to increases in allowances year on year. So our total adjustments with these line items comes to $102.62 million. Then we look at our pro forma pre-tax income, $154 million versus $51 million. We estimate XPO's normalized pre-tax profit is approximately 67% lower than Street, less taxes. We see, we use a 23.5% implied effective tax rate. And then we see with our diluted shares and adjusted net income that we arrive to an adjusted diluted EPS of 34 cents versus the Street's $1.03. Seeing a greater than 48% decline versus the Street's adjusted estimates. EPS and price to equity ratio valuation. A downgrade and or loss of access to capital has the potential to drastically affect XPO shareholders. We estimate a downside risk between 20 to 60% with the intrinsic valuation to cause the market to reassess XPO's earnings quality, credit rating adjustments, and business quality transitioning and expanding into a more capital-intensive business, warehousing. So we see our PE multiples, a low consensus multiple of 26. We retrieved that from Zacks Investment Research and Bloomberg figures. Then we see our EPS adjusted figure of 34 cents, price target of $8.81, mid multiple of 100 with the same EPS, price target of $33, and a high multiple of 200. With the adjusted EPS, we see a price target of $67.77, and that is a 44.75% decrease from its closing price of $122.66. DCF valuation assumptions. We look at each line item: revenue growth, 2027 estimated EBIT, 2027 EBIT margin, and its weighted average cost of capital. First, we'll look at our bull case: growth at 2%, revenue growth, EBIT growing at the same 5-year average of 16%, EBIT margin of 9.25%, and the average 5-year weighted average cost of capital at 8.3%, price of $72.30. Then we look at our mid case: 0.59%, 787, so the same EBIT, 9.91% margin versus weighted average cost of capital of 9, price target of $54.25. And then look at the price targets in bear, $43.46. We estimate the mid and bear cases are reflected to be the most probabilistic based on our views. As we see it tabulated, the highest at $72.30, $54.25, and $43.46 per share. Total value per share, not including any dividends paid out, if any are paid out. We believe the EBIT will be likely between 760 to 800 mil in 2027. We estimate the value per share year end between anywhere from $55 to $43 a share. If revenue and EBIT improve for the bull case for the next several years, we see a year end 2027 total value per share of $72.30. Long bias clouding judgment from institutions and analysts. It looks like long bias exists within XPOs and institution holders and analyst ratings. While Chinese walls and regulatory policy and governance exist, it becomes hard to disassociate a conflict of interest between below institutional holdings and analyst arms of business. If you had a multi-million-dollar long position in a stock, would you want a downgrade on price? Stock price movement and technical analysis. In over 365 trading days, XPO stock has increased over 130%, a very large price move, which almost seems improbable despite fundamental factors pointing to the opposite. Implied volatility and calculation and methodology. If we look at the standard deviation of implied volatilities of 0.561%, we look at the average implied volatility for 1 year of 35.16%. We then calculate the 5 standard deviation calculation, which uses the average IV plus 5 times the standard deviation of implied volatilities. We see that price move equivalent to 37.967%. The price move of XPO underlying stock in 1 year was 136.66%. Based on the average implied volatility, a nonsensical, improbable event has occurred. The 1 year implied volatility says that a price move of 130% that has occurred is greater than 5 sigma. We are going to like the odds of buying deep out of money options for a price move in the back opposite direction. Probability of the price move and perspective. As we see in this tab, a 5 standard deviation event is equivalent in any given day 0.00029%, obviously a lot larger given over a time span of a year. However, it's still very unlikely move. We are going to like the odds of purchasing deep out of money options for a price move back in the opposite direction. We also see in over 62 years in the S&P 500, there's been minimal sigma events where stocks and broad-based indices have produced moves over 5 standard deviation. In other words, a highly improbable price move. We see this tabulated with only 10 5 sigma events occurring in the S&P 500 in over 62 years. Mispricing and valuation of options. This is what we think the market is pricing currently based on the last traded price and volatility adjusted. This is based on the closing price of $110 in May. We see annualized volatility of 39.92%. The options were trading around 2.92. We were looking to potentially get into as an idea of a trade. Market is assuming volatility to be lower at around 39 to 42%. versus our estimates at greater than 50% of full annualized volatility, as we see down here. We calculated on prevailing market factors, long-term, risk-free rate decreasing, the volatility of stock price returns over the last few years, and market discounting volatility and price risk. Normality testing. We used Kolmogorov statistic test with a p-value of 37.71%, Shapiro-Wilk test with a p-value of 62.29%, and the Jacques-Veyrat test of 0%. As we see, we weight the results, however, 2 to 3 of the test point to option prices still assuming normality. Therefore, we ought to know the option we intend to purchase is not skewed and reasonably priced despite the presence of a bimodal event. Theoretical and market pricing of the options. So I use our source of bar chart and Saxo Bank, which is a broker, and our estimate. There is a 5.2% spread between annualized volatility, a $2.98 theoretical option price spread, a delta spread of 0.036, and a risk-free rate spread of 60 basis points. Market is undervaluing the volatility risk and increased volatility. And as volatility increases with a decline in stock price, we will see large option prices increases. An example of a trade, look to go long volatility by purchasing put option or bet against as overall volatility increases and the stock begins to trade at low intrinsic value or multiple, will see great returns. Risk management is locked in at the premium paid of options. Inclusive is embedded leverage within the option contracts as one contract is equivalent to 100 shares. Thank you guys so much for watching. Hope you enjoyed the video. Have a great rest of your morning, afternoon, evening, and we'll see you next time.